but not from the markets, from all the, don't even record it. We got all I have is about 25 minutes anyway. What's going on?
Nothing. Angela and I were just talking about, the Chinese and why can't we, sentence people to death over here?
Right? I mean, don't they hang people in Singapore for spitting gum out on the sidewalk?
You know what? As the great Judge Roy Bean said, sometimes a good hanging focuses a man's mind.
Oh boy.
All right.
Well, Ira, what I'm thinking. I'm sorry. Go ahead.
No, go ahead. No. We're leaving off in a good place for Monday, by the way. This will actually.
All right. Well, I mean, Ira, what I'm thinking now is that as the dollar continues to soften, I'm guessing it's going to stair step its way down. We'll have counter trend rallies, of course.
Oh, of course. Yeah.
All right. But now, I don't know if you've noticed, but the softs, coffee, cocoa, are trading very nicely inverse to the dollar with the reflation trade.
Well, actually, I didn't know. That's why I kept talking about the Bloomberg Commodity Index. You see how that's broken out so that actually anticipated, because that moved first, believe it, and the commodities have been moving with oil. And so you are getting some things in lockstep here. And you know what? There was a piece from 1965 I read that Mike Temple sent to me from the Harvard Crimson. It's hard to believe, but it was really a good piece talking about the dollar in 1965, and it's the same discussion today. The problem is that the spread of dollars is so great that it actually works to sustain itself, but there's, the Chinese were out today talking about, what was that article, about not wanting to use the dollar, blah, blah, blah. There's a lot of stuff going on around in which people are not happy. And the more that, every time Mnuchin jumps for joy and claps his hands, we did more sanctions, it doesn't actually work in the U.S. They're over-sanctioning everybody, and it's coming back. And it will come back. It hasn't yet, but it will come back to haunt them.
I mean, I'm not suggesting that the dollar's going lower because of all of that geopolitical stuff. I think there's certainly some influence, at the edges. But to me, the dollar is still driven by the economic cycle. I mean, it still matches up perfectly with how I track the cycle, and now it peaked out October 1st, right on time, according to my schedule. Yeah. And now here we are. But that's because my models still have growth continuing to decelerate. Retail sales rate of change, industrial production rate of change, all that shit's still, rate of change lower.
Well, it's a very good point. And you see it. Look, everybody's talking about how big Amazon sales were, okay? Okay, Amazon sales were big. But Amazon sales come, they come out of everybody else's pocket. It's not like you're creating more. So why aren't you just buying the Amazon and selling the rest of the market, or the rest of the retail merchants, because it's coming out of somebody's pocket.
Well, somebody did that yesterday.
Yeah, I mean, Ira, what you're saying is it's a zero-sum game.
Not always, but this time, first of all, don't tell me how good the consumer is. I just cannot listen to one more, because if it's, again, I think we talked about this the other day, if you're not talking about the consumer and the amount of credit card debt that they're carrying, you're giving me half the discussion, because all you keep doing is bringing demand forward. That's what a credit card does. I can buy today and worry about tomorrow. But if I want it today, I can buy. That doesn't mean I can keep buying more and more tomorrow, because tomorrow does come and those debts are owed. So if you're not linking the two conversations, you're nothing but a pimp for the south side of Wall Street. That's, you know, because you need to discuss the debt load that people are carrying.
Yeah. Well, Ira, that's the frequentist theory, and Wall Street discussing levels, okay, as opposed to second derivative calculus.
Well, that's a very good point, and that's where we lie. So yeah, they roll these people out to discuss this crap, and I go, wait a minute, talk about how much people are going into debt to do this. When I read that article about the auto, we talked about that the other day, about the auto debts and how they're saddling these people. I just came from a dealership. It's not why I was there, but I listened, and I, you know,
Ira, you know what's really scary about that? You know what's really scary about that article? I don't know if this went through your head, but it went through mine. I'm reading the article, and I'm like, how stupid are these consumers? Let me get this straight. You make $660 a month, and you're signing off on an $800 a month car loan?
Yeah, it's got a whole lot of good to it, huh?
You know, and that was the theme throughout the article. Okay, so the dealers are fudging numbers. I get that. But, you know, when they say to you, okay, your payment is $992 a month, right? And your income is $2,000 a month or $3,000 or whatever, you know what your budget, most people know what they can afford, right? So, you know, so I just can't wrap my head around what these consumers are thinking or not thinking, as the case may be.
You know what? That's a really good point. And they go, what are you going to do? Repo my car? At least I have a car for X amount of time. You know, I don't know what the operative mindset is because, you know, and I say this with great empathy, I haven't been in that situation. And thank God my parents taught me if you can't pay for it, you really don't need it. And you'll figure out a way. So, and it's not always doable. So I am very empathetic when you need it on.
Yeah. I mean, it can't be a good thing.
The little table.
It can't be a good thing when you're trading in your 2015 Nissan Altima where you still owe $3,000 on it. You trade it in and roll the $3,000 into the new loan. Like that can't be good.
No, it's listen, but you know what, I feel for people. And yes, okay, yeah, they should be smarter. But you know what, they dangle enough in front of you, and then a cash back, and then an incentive, you know, they don't do the math and to figure out that, hey, this is not going to serve me very well. And you know what? The problem is that the used car market has been hot because, again, people are searching for vehicles of all stripes and sizes. And
I'd never buy a new car again. It's crazy.
Oh, God. First of all, because the technology changed. I just bought my brother-in-law's. I'm down here in Arizona. I'm driving a 2013 Lexus with 35,000 miles on it. You know what? And you know what? And it serves me well because the technology is going to change so fast that I'm basically saying, oh, I'm just going to buy an obsolete car.
Yeah, plus they can't track you on that one.
I'm sorry?
They can't track you on that one.
Yeah, they can track you. I got my phone with me. What's the difference? They'll find you somewhere.
Oh, you know what? Yesterday, my daughter and I are leaving the gym, and there's a Taco Bell that she goes to near school down in Manhattan, right?
Yeah.
And she looks at her phone, and it goes, oh, 1 hour and 10 minutes to Taco Bell.
Oh,
I know. And it drives me crazy. It tells me where I'm at, how long it takes me to get home. I go, how do
you know? And she goes, that's creepy. And I said, well, you know that your phones track everything you do.
Yeah, they don't realize it.
No.
Somebody's following you for some reason, either to direct you to the nearest retail vendor of some sort most of the time. Yeah.
But the stuff pops up at the weirdest times.
So Ira, I was looking at this bond rally that we got going on here, and it's kind of been a stealth rally over the last few days. And it's really the short end of the curve, too.
Well, not, the fives and twos, of course, but let's go back to the point that Angelo just made. Angelo, speaking about the commodities, right, with the cycle.
Yeah.
If the rally in the commodities and the bonds has had my attention for the last few days, or at least certainly this morning, I will say that, and yesterday, because what's this rally about? Is it just trying to front run the Fed into the end year, thinking that they're going to have to come and do something, that you're going to wind up with a repo situation on Monday and Tuesday possibly? Because for the life of me, why would you, looking at the commodity indexes, you'd be really hard pressed in my mind to purchase
The bonds.
The bonds, yeah. Well, why would you?
Well, you know what, Ira? I'm glad you mentioned that. So I agree with you. I was telling Judd yesterday and today, I'm of the opinion that the dollar gold bonds and the softs are basically front running the Fed. So what I'm seeing so far is that I'm expecting a marginal inflection upward in inflation. Okay, nothing that's going to knock the cover off the ball, all right, but enough to do some trades. And so the 30-year Treasury bond and growth, inflation inflecting upwards, right, the two are not mutually exclusive because we still have growth decelerating. So the reflation part of this trade is simply the Fed cutting rates. And we've got the growth continuing to decelerate. So in my models and the way we've back tested everything, I've been telling Judd all week, I'm waiting for a big break in the bonds at some matrix level so I can buy the shit out of them again for January and February and March maybe.
Well, but that can, listen, the mindset out there, you hear it from Druckenmiller, you hear it from Gumbach, not that they're the being and end all. I like to hear what they have to say, but that doesn't mean I'm walking in their shoes or in their tracks. No, I don't do that. It has to work for me in the way I see things. But, they're really negative on the longer end of the curve. So they're looking for steepeners, part of for the reason that we're talking about.
Yeah, no, I understand why they think that. And, I'm not saying buy 30-year Treasury bonds as a 1 or 2 year hold. I'm not saying that. But for me, it's for 0 to 4 to 5 months.
Oh, listen, it may well be because you're looking for a flight to quality to escape some of the. I'm not going to call it
a flight to quality to escape what's happening in the data, the rate of change in the data.
Yeah, and the fact that the equity markets, and I'm not talking about global equity markets, but the U.S. market has certainly run way ahead of itself. I mean, profits in the fourth quarter, they know, and even third quarter profits were not dynamic enough on a pure PE basis to generate this run in the equity market. Okay, if interest rates were 3%, do you think we'd be here?
No.
No. Well, Ira, third quarter S&P 500 earnings, EPS, all right, finished at negative 1.1.
I know. I know. And that's why I'm saying they're racing way ahead.
Yeah, and so if revenues are declining and wage growth is just a little bit sticky, what do we think might happen to fourth quarter profits when we start getting them next week and the week after?
That's right. That's and this market is now, forget where we were at, but what is it pricing in? It's pricing in nirvana. I always get nervous when markets price in nirvana because nirvana doesn't come. So
at some point in the first quarter, right? I think the Fed's going to have to cut rates. I don't think they should, okay? Because that's a whole nother conversation about QE and all of that. What's the truly right thing to do? But that's what Powell's going to end up having to do if what's taking place continues to deteriorate?
Well, I'll say this. If Powell has to cut rates, these curves will steepen dramatically. Dramatically. I will say that right here, right now. And we've seen, here, I got the charts in front of me right now.
Now, do you think, no, Ira, do you think, are you saying that because you think they'll buy the crap out of the front end?
Yes.
Okay.
And they may even sell the further out, just like they did. You know, go back and look, go track the dates of commencing QE, and the first two QEs, the curve steepened dramatically. You know, listen, they commenced with this QE, and should we look to see what the, I'm looking at the 210 right now, and let's see.
Yeah, I just threw it up too. I use the futures on it. Futures.
Yeah. But let's be clear. I mean, it's all a trade as far as I'm concerned.
Well, sure, it's all trade. There's not. With the what central banks and the geopolitical risks out there, everything but stocks, quote unquote, stocks are a trade. But even though, you know, we know that stocks will become a trade because they've run so far ahead of themselves. But that's what makes a market. And again, with low interest rates, where are you going?
Yeah, I mean, Judd and I were looking at the bonds earlier in the week, and we were just shooting the shit about, you know, how far down we think they could go, right, before they might hit a level where we'd buy them. And now it's starting to look like that might not even happen.
Well, again, I want to see what happens with these curves, because I think the curves are going to do a lot of work here this year, because, you know, I'm just listening to what Gunlock has to say, and I'm listening to Druckenmiller, and I've been on the page where they're getting to. Now I'm a little bit nervous, but the amount of debt is a serious consideration for a lot of people now, where it was totally, you know, people kind of laughed about, the debt, who cares? It's not a who cares anymore. It's gaining traction, because there are some people who think that the repo situation is due to the vast amount of debt that's been out there. It's, you know, and it's really caused some havoc, because so much of it is in T-bills, and then you have the Fed doing what they're doing in the repo market. So you have a lot of very powerful, and I stress the word powerful, forces. These are you know, me buying 1,000 T-bills on an order. You're not talking about it. You're talking about serious, significant players with needs, and when they buy it, they take it away from the market, and then there's a shortage because people need, and they don't want. People are waking up to the fact that they're now in Ira's mantra. You got to be an idiot to extend your duration with all the amount of uncertainty. And I'm not just talking about political uncertainty. I'm talking about fiscal uncertainty. You got Europe, who may be embarking on a fiscal stimulus. You've got a lot of things in motion here. In fact, that's going to be the theme of 2020, is really things in motion, because when we've sat here very complacently, you know, and some people are even warning we're on the precipice of a Minksy Moment because of so much complacency built into the system. I happen to believe in that. That's exactly right. That a lot of things will come. You know, you can only keep pressing things down and pressing things down and pressing things down through monetary creation to slow volatility. But the market, one of my rules of being involved in markets will eventually win out. But that's the corollary to Keynes's, you know, markets can remain irrational far longer than you and I can remain solvent. The markets will win out. It's water. Money is like water. That's why they call it liquidity. And it will seek its most vulnerable area. It's what happened in 2007, 2008. You blew up you inflated, I should say, the housing world, and you found out where the vulnerabilities were. And of course, they were mortgage-backed security and asset-backed securities, leveled up with credit default swaps, leveled up. So it just kept pushing at it until it's found its weakest point, just like water does. How does water, how does it go? It just keeps pushing and pushing and pushing, and it finds its point, and it will do it. And markets will do it too. I have no doubt about that. Can I tell you exactly when? No. If I could, you'd be paying me a fortune for this service, and I'd be retired, and be sipping a mint julep right now. But that's not the way it works. But it will happen because that's what markets are supposed to do. Right now they're being prevented from working. It's what central bank action has done. It's prevented the market mechanisms from really being the signaling device that they were meant to be. The market has so many mixed signals, it doesn't know how to read it, so it takes the easiest path upward, which is, of course, the equity markets. Go ahead. It's like Judd says every day. You want to sell this stuff? Go ahead and sell it. I invite you to sell it. Go sell it. But it's a fool's errand.
Ira, you said something at the beginning of this. It's my understanding, with regard to repo, it's my understanding that after they raised the debt ceiling, somewhere in the neighborhood of $1 trillion of shorter-term paper came to market. And then it seemed like the broker-dealers, the primary dealers, started to choke.
Yeah, they did. They had just too much. So they, and you see, they'll only do it when there's enough money to be made on what is historically called the arbitrage. So I'll take cash and lend you my securities if you're willing to pay for those securities more, or vice versa. If you're short cash and you need to raise cash, I'll buy your securities and lend you cash, but there has to be an arbitrageable trade there. If there's not, nobody's going to do it anyway. I don't need to do a bookkeeping entry just for the sake of doing a bookkeeping entry. That's silly.
So if there's one of the issues I was having some trouble with is, so if there was a shortage of cash, right?
Yeah.
How is it that people think a large chunk of this repo money has worked its way into the stock market?
Well, because again, what do you do with your cash? What do people need cash for? They may need it for margin, for securities, for equities.
That's true. I mean, I get it if a hedge fund repos $100 million of treasuries, right? What are they going to do with it? They're going to try and earn a year-end return.
They have purpose for it. So, is it buying a dividend yielder? So it's always, can I do better with this? And what's the duration? Again, duration is very important. Most people don't think of. See, the bond ETFs have made people very, very lazy. They just buy them, and they don't even realize what's in there and what purpose it's fulfilling. They just buy them. Oh, it's easy. Okay. It's one of the parts about the world in which we live in. So, all right, I'm going to have to jump off, but I think it sets the table for Monday. We've talked about the currency. So it took a few days, and Judd made, again, is that when was that? Wednesday evening, it no doubt took place in New Zealand, in Wellington, where it usually takes place, and we saw a spike before the futures markets opened. Was that Wednesday night? Yeah.
Well, it was before the morning, Ira, and then they actually had a 113.15 print in the euro. So they've taken the euro prints out, okay? But you're
talking about in the cash though, right? I never saw them in the futures.
In the cash, I had 113.15, and then the next night it was 112.49 or whatever you saw. But I called CQG because they haven't fixed all the euro crosses yet.
Yeah, it's typical. They don't.
Yeah, you can see euro yen. They haven't fixed euro yen. They haven't fixed euro Aussie. They haven't fixed any of the crosses yet. I mean, look at euro Aussie. They haven't fixed it.
Okay. All right. I'm going. We will. It's for me. We'll set the table for Monday.
Okay. Thanks.
Okay. Hey.
All right. See ya. Well, that was fun.
Well, it's always interesting. Every time he tells me not to record, I record.